Hey, hi there. It's Neill Christiansen, and welcome back to another episode of Mile High Market Talk podcast, where we bring local professionals to the stage so that they can share their expertise and educate those looking to build their overall wealth. In today's episode, we're going to unpack the smart money moves you should be making in 2025, whether you're just starting out or already well on your financial path. We're going to focus on some practical steps anyone can take to protect and grow their overall net worth. I'd like to introduce our local guest today, Neill Turner with Strategic Wealth Partners. Neill is a seasoned financial planner right here in our community. He has helped countless of individuals and families navigate their financial journey from protecting their assets as well as helping them grow long-term assets. Originally from Detroit, Neill moved here to Colorado to enjoy the outdoors as well as the lifestyle that it had to offer. If you're just starting out or already well on your way with accumulating assets, today's episode will offer tips and strategies to help you better prepare for retirement. So without further ado, I'd like to introduce Neill. Hey, Neill, how you doing?
Good. Happy to be here. Thank you, Neill.
Very good. Very good. And just so the listeners know, this Neill spells it with two L's. I only spell it with one L. So I don't know which is the better way to do it, but it's very unique to see Neill with two L's. I'll just say that.
Yes.
So Neill, in that intro, I was talking about, protecting and then growing. And I think with a lot of us that start our financial journey, we're kind of just told to, hey, grab a 401k, put as much as possible as a way that you can on a monthly basis, and then hope for the best 30, 40 years down the road. But I think there's that piece of protection that none of us really understand or even are educated enough about it. So my first question to you, protecting today before building tomorrow, and specifically, what are the most critical steps individuals should take in 2025 to safeguard their financial foundation before focusing on growth?
We work on the protecting today before growing tomorrow because, one, it's actually something that is easily done in a very short period of time. It's also something that most people are not thinking about the way that we're thinking about. It's in the world of investments. I'm going to diversify my portfolio. I'm going to make sure that I'm not too aggressive so I don't, tolerate all the market's ups and downs. I have a bit more sort of a smoother ride. And all of that is accurate and true, and we want to do that as well. However, there's also a lot more that can be done to just protect our overall financial world. And that's where we start with our planning, is to see where the clients of ours are at. And we do an analysis to find out what that sort of looks like for them. And then we educate and go through that process of telling them where the gaps are, how things in their world work. In the world of protection, it's I think a lot of times maybe insurance when you get outside of the world of investments. I would say insurance, legal documents, those types of things are extremely important because life happens to all of us. At some point in time, we're going to have deductibles to pay. We're going to have a fender bender. We're going to have something of an illness or things that, can throw us off. And if we're not prepared for those types of things to a significant degree, then we will have a lot of debt that occurs, or we'll have liquidity that we need to throw at this different issues that come about. So that's one of the big challenges that we see. And if you look out there, the biggest debt that people have outside of their home and credit cards are medical bills. Medical bills really can tank an entire family if they're not properly protected. So we talk about umbrella coverage to go along with their auto insurance, their homeowner's insurance. We talk about legal documents such as estate planning documents, wills, powers of attorney, trust, things like that. All of those are ways in which you can protect your wealth. And while they may not be used very often, and that's a good thing, we want to make sure that when they are used, they're robust enough that we're not going to have our assets be affected, or we're not going to have other challenges that cause us to maybe have an inability to grow our wealth. So we can't go to work or things like that where we're delayed in getting back to the income generating sort of day to day. So that's really where our thoughts come from. And all that can be done within a few months. But if you want to grow an investment account, that could take decades when you think about your retirement timeline for some of us. So protecting our world is actually much easier in a short period of time than growing our assets to build for retirement and so on.
So would you say then, people that are working for a company, corporation, they tend to have benefits, right? And when we think of benefits, we think of, health insurance for the most part. But do you guys take that client through their their benefit package to see what other type of protections that they might be qualified for to kind of start there as a protection piece?
We sure do. The client that I had been working with, or I'm working with currently, is reached out to me, said, I got open enrollment. Can you look at my benefits? Give me an idea of what you think here. And sure enough, we start scrolling through and seeing all the different benefits that we are more commonly used to: health insurance and life insurance. And then we got to the disability, and she had declined any sort of additional coverage. She only took what the employer was going to pay for. And she has a unique income stream where she has a very small salary, and then a lot of her income is in the form of commissions. Well, her disability coverage only covered her salary, and that would have been about an 80% loss of income had she had a disability claim. And she was not aware of that. She had no idea how the coverage actually worked. And then the buy-up coverage that was offered was going to be such that it protected a bigger portion of her income, but it still did not address her commissions. So in that case, then she wanted to go out and seek additional coverage, personal coverage in the open market to cover those commissions. And we got her to a place now where she'll have about 70% of her total income covered by disability. And that was something that she would not have been aware of until, unfortunately, something would have happened. She made a claim. So we do a lot to go through the group benefits to make sure everybody understands how they work when they need them.
Yeah. And I would think that, disability insurance, when it's through like a group plan, especially if the employer is fairly large, is probably pretty affordable. It may not necessarily
Yes.
be too much of an expense on a monthly basis, but it's a great point you bring up, because if people are on that commission bonus percent or more of that income, all of a sudden you get hurt, you realize that, oh, geez, I don't have that much money coming in, because it only goes to that salaried amount, as opposed to if you were to look out in the marketplace and find something that is a little bit more of an alternative disability. There's plenty of those things that are out there. One should definitely consider that. So it sounds like you're really not only just taking a look at what their current plan is, but also going out further to make sure that they're truly protected in that example that you were given.
We're very thorough in that way. And I would say most disability coverages in the group setting through an employer don't cover much more than maybe 60 to 70% of someone's income. And that is often where people find a big gap and they're not aware of it. Now, likelihood of being disabled on a permanent basis isn't that high, but it's also not something that we're concerned about as far as permanency goes. We're concerned about how do you get through a 90-day period, a 6-month period, or even a year. What kind of coverage do you have there, and how does that work? If it all comes together and we don't have a disability claim, well, that's great. There's a good amount of people that will have some sort of disability claim and need those benefits. So we want to, talk about it.
Absolutely. Absolutely. And you were kind of, talking about it's a challenge to build your net worth when you have debts that are equal to, or I guess exceeding what those returns can be. So you feel like you're doing the right thing by putting money away. But like you said, besides your house and credit card debt, which, credit card debt right now, I think is over $1 trillion in outstanding debts, that they tend to be a lot higher in percentage than the markets that we're used to putting our money into. Not to say that we can't have a good year or two, but credit card debts tend to be pretty high on annual percentage rates. So it's what I'm getting from this first conversation here is you got to take a look at everything. You got to be very comprehensive when you're looking at this, just because you might have a good amount of wealth built up. But if you have more equal to or more debt, you're really kind of going backwards with it, just because you're not able to see much growth when all that debt has to get paid in full.
That's exactly right. And you can see this in the world of doctors and attorneys, where they come out of college with a sizable amount of debt. And while that debt provided them an excellent education, more times than not, and they're going to go out into the workforce and generate a pretty good income, if not an excellent income, they are still sort of weighted down by this debt load that is dragging on their ability to grow their wealth and so on. So it's kind of, I liken it to driving in your car with the parking brake on. You can only go so fast before you just feel like there's a slowness and a sluggishness, and you're just not able to move. And you realize, if I take that off, then I can really get to where I want to go. And that is how I see the world of debt. And while that debt with the student loan has been beneficial, not all debt has been beneficial. Credit card debts, as your example there, are really quite detrimental because of the high interest rates and so on. So we do want to pay our debts off, but we also want to save and we want to grow our wealth, and we want to at the same time make sure that we're protecting ourselves. So there's a puzzle piece here that or a puzzle that we take into consideration, and how all those pieces come together, and sort of what's the priority. And we want to worry in priority as well. I think generally we're told in our environment here, get a job, put money in a retirement account, and have a good life. And I'm simplifying that. However, there's a much more nuances and complexities that go into a financial plan. And that's where we really come in and educate and help our clients with.
Yep. I love that. I think it's very easy to kind of just put the money away, but to have the protection, to understand the insurance pieces, to perhaps have an emergency fund, or maybe even 3 to 6 months of reserve and so forth. I mean, there's all these little things that, one should be considering before they're building wealth, to make sure that they can handle those unexpecteds, so that they're not putting themselves back in that corner where they just came out of. So a great start there with the protection piece. Okay. So now, we're moving towards wanting to build that wealth. But the next question is, what are the biggest financial mistakes or misconceptions you're seeing as we continue to push forward into 2025? And how can people avoid these, especially considering the current economic conditions? And I'll add on that just a little bit, because I don't think any of us really anticipated what the trade war, the tariff would have kind of done to the markets and so forth. So we're kind of in that. What can people do currently to manage that and maybe move forward in a positive direction in 2025?
I think the one big thing that comes up in any sort of down market or any sort of turbulent times with the markets is an emotional, sort of overwhelming feeling of, am I going to lose everything? Is this going to be bigger than what it was last time I dealt with this? Is it different now? And therefore, because it's different, I'm going to have more challenges. Every time markets do what they're doing today or this year so far, people will have that experience to some degree. Even the most sort of sound, calm investors do question. I even question, and it's my world. But what I would say is, when we don't let that emotion get the best of us, or we're able to compartmentalize a little bit more, or able to sort of suppress that heightened sense of emotion, then we find ourselves coming back down to a better understanding of, all right, what do we want to do here? What makes the most sense? And really, for most people, if you have a retirement timeline that's probably 10 years or more, it's stay the course. And assuming your accounts are invested in a diversified way, which would be one key factor, both on how to protect your wealth, but also on how to just grow wealth in general, then you can weather these storms. And then the one big benefit of these downturns is adding money. So you're putting money in your 401k or your retirement accounts, and you're buying at a low point right now. And if you go back in time, there have been many other low points that are far exceeded by many, many, many more high points. So while we're putting money into a low point today, we are historically expecting now, moving forward, that the accounts will grow and there will be other high points and more growth and more opportunity to build our wealth as a result. So it's really not getting caught up in the emotion and trying to maintain a long view. And that is very, very difficult, I know. But that's really where an advisor does their work. Everybody can win when markets are going up, more or less. The good advisors actually are the ones that can help mitigate losses to some degree and mitigate really the emotional turbulence that a client's dealing with, and not pulling money out too soon or not making adjustments and realizing losses and so on as a result of their emotions.
Yeah. I think too, I've always heard, when in doubt, zoom out. And when you kind of, take that for what it is, you got to, if you go back to Stephen 2 years, 3 years, I mean, the market has been doing quite well, right?
Yeah.
And when you do that zoom out and you realize that these small dips are just that, it's just kind of the course. If you're wanting to be in the market, it's just something that you have to deal with. But I also wanted to kind of, address the behavioral piece of a financial planner, as you kind of just alluded to. Now, it almost is like 80% behavioral, 20% kind of the accounts and so forth. How can someone right now, considering that we're in a volatile type of market, what do you do to help that person kind of get through this time phrase? I know you just kind of talked to them about, 10 years plus, it's not going to be that big of a deal. But let's say they just enter retirement or they're in retirement. What do you guys do with folks that, kind of want to understand what they can do for 2025?
It depends on what they've done before 2025. If they've been working with me and my firm, and we've been doing retirement income planning, then we've taken a bit of a different approach than just the investments solely for their retirement. We're looking at guaranteed income. We're looking at pensions if they have them. We're looking at permanent life insurance if they have that as well, to go along with their investment accounts, such as retirement accounts or non-retirement accounts, like a brokerage account, if it were. We're taking into consideration the whole picture and seeing where income can be derived from, where cash flow from these assets could be derived from, to weather these types of storms. And one thing that we do with all of our pre-retirement clients and retirement clients is we extract typically a good amount of cash early before the retirement actually starts. And we sit on a bit of that so that they don't have to worry about the market turbulence. They have a cash bucket that is there to fund them for a handful of months or more based on their level of comfort, so that they can then make adjustments. The worst thing ever is to have to be reactionary when markets are like this. So we want our clients, and we want to operate as well in a more responsive way as opposed to a reactionary way. So the diversification of assets and the diversification of investments within those assets is important. And I would also say diversification within tax structure is important when you're at retirement. Yeah. So it's not about how much money you have, it's about how well you can spend it.
Right. And avoid the tax piece that often comes with it as well.
Yeah, that's correct. And we'll say to clients, and we say this a lot right now, investments are like a bar of soap. The more you touch them, the more they go down. So you just want to sort of minimize how much you're touching that bar of soap, because you need it to last for quite a long time. And especially retirement clients, it's not uncommon today to see 20, 25, 30 years, which is kind of a big misunderstanding that people have at retirement, that they're going to live, I didn't say healthy, but they're certainly going to live statistically a pretty long time.
Yeah. I mean, I think it's in the 80s for both men and women. So, if you're retiring early 60s, like you say, you've got 20 plus years that you need to try to stay healthy and make sure that those assets, help with your lifestyle, but also continue to grow as efficient as possible. So that's great. Okay. So we've talked about the protection piece. Again, I think that's just number one. Make sure that you're aware of how you can protect as the assets start to grow. Number two, we've talked a little bit about, kind of what has happened here in 2025 and how you guys prepare your clients so that they're not so much worried per se. It's not to say that they can't have some doubt or some uncertainty, but it sounds like you guys do a great job to prepare them. I love the bucket strategy too. I think that's just one of the best ways to prepare people. All right, but so we've done all that kind of stuff. Let's now kind of jump into investing for wealth building. So what's your approach to smart investing in 2025 and beyond? Can you share some actionable tips and strategies, whether you're a beginner or if someone has truly kind of been in this market for quite some time, some friendly wealth building steps that you can share?
I think when you're a beginner, I started when I was 19, and it was not because I was smarter than everybody else. It was because someone told me that was much smarter than me that I should probably do something better with my money compared to the friends that I was hanging out with. And I just happened to listen. Why I bring that up is because I think the sooner you start doing any sort of investing, or the sooner you start building anything, the better you are, because you have the beauty of compounding on your side. And so if you can just create a Roth IRA or an IRA like I did, but I think Roths for younger people are a little bit better because of the way that they work from tax perspective and so on. That could be a good place to start, along with maybe retirement accounts at your employer. You could also utilize like a brokerage account, and you can start these up at any number of online places as well. But just having these accounts there, one account being more for retirement, one account, the brokerage account, being more for any point in time along the way, today and all the way through your days, and just consistently putting money in. That's really the big key. It's a good savings habit first, and then a good contribution habit second. And then, there's Warren Buffett has been famous for saying, if you just invest in the S&P 500 and let it go, you'd be better off than most people that are trying to buy and sell stocks that they think are important or they like or what have you. Just sort of set it and forget it, but keep contributing along the way. And you'll see that sort of curve really start to take off after a handful of years. And over a long period of time, that can add up to hundreds of thousands of dollars of growth, because you're compounding dollar after dollar, return after return, year over year. So I think that's a big thing for first-time investors or beginners, younger people. That does not negate, though, the desire to protect yourself, or the need, I think, to protect yourself.
Right.
That doesn't negate to pay down, your debts and so on. It's an all. It's not an and. It's an all. Mm-hmm. And I should say, then you have your sort of more experienced investor. The same sort of basics apply.
Right.
It doesn't go away just because you get older and you have more money and you're a different person than you were 10, 15 years ago. What changes, though, is the diversification of assets. So now you may find yourself with real estate because you want to be a landlord and have a rental property, or you may find yourself with a business. You also see where permanent insurance may come into play here. You see different types of buckets, essentially, that are assets within those buckets. And that diversification, again, still has the same sort of view in my mind, which is it's not an or. I think I said and earlier. It's not an or, it's an and. Mm-hmm. Put money into all these different places consistently, and they will all grow at a pretty good rate with that consistency. And then they will be better off in the future because they have diversification of assets. And those assets are all taxed differently. They have different liquidity. They have different uses and control. And they have different inputs from sort of outside sources like IRS and government and taxes, changing. So that's really where a more sort of mature investor can benefit.
Yeah. I think, isn't there the rule or the story of someone that's investing at 25 to 30, then they stop, they would actually have more money than the person that started at 30 through 65. I think the math works out that person who started 5 years earlier, but then stopped, would still win that race, if I'm remembering right.
Yeah, and that's an interesting sort of story there. We illustrate that when we go through the planning with our clients, and I'll show a 30-year timeline with $10,000 going into an investment account growing at 5%. And over time, that 30 years that account grows to about $700,000. And if we look at how much they contributed, well, that was only $300. So the account has grown more than double what they contributed based on that compounding. And then if we back 5 years off of that, what happens is they didn't contribute $50,000 because that was 5 years times 10,000, but the account dropped by 200. So they lost $150,000 of growth simply by waiting 5 years and making contributions to that account. And that is significant when you think about all assets work the same way. Now, here's a pro tip. The same thing happens when you have a credit card. So just take all of that growth going this way and do the inverse. Now you have a credit card doing the same thing, but it's working against you, and you're paying American Express or Visa or whoever it is, and you're not paying yourself. Right. So it's a big deal to understand how the beauty of compounding works, and then the consistency and contributions work.
Yeah. If you have a unexpected medical expense, or if you've racked up some credit card debt, et cetera. So super important to start with looking at the protection side first. 25, I think we've come to the conclusion of, well, unless you're kind of in retirement and you've planned accordingly, there really isn't much you should do. The market might correct, and it might continue to correct. But if you're 5, 10, 15 years from retirement, zoom out when in doubt, and you'll notice that the market continues to typically go up, which is in our favor long term. And then from a wealth building standpoint, like you said, there really isn't a trick. It's a matter of putting money away as early as you can, letting it sit, staying out of as much bad debt as you can, and with the intent that, in retirement of maybe say 35, 40 years, you should have done really well. Your assets would have been doubling accordingly. and you should be very prepared for retirement. I think that's the piece right there. Is there's really no magic to this. It's just a matter of staying course, um, keeping your debts as low as you can, and realizing that the market is here to help us get to a place so that during retirement we can really enjoy that time. So is that a good summary of what we discussed here today, Neill?
Yeah, I would agree with that. I think perfection is an illusion in the financial world and otherwise. And so, just having good habits and being consistent is no different than our personal health. The financial world works in a very similar fashion. Are there nuances and tweaks and other things that someone could do? Sure. But generally, if you don't have those basics in place, like you've talked about here, and aren't being consistent, then things will be a bit more bumpy than someone that would, or maybe a lot more challenging than the person next to you.
Yeah, agreed. Well, hey, Neill, this has been a great conversation. I hope our listeners have gotten some good tips and some strategies on how they can proceed. Where can people find you, if they have questions and so forth?
My website is mystrategicwealth.com. You can certainly check our website out there. We can reach out to us at our office through that website, and we're happy to be a resource to anybody. I'm happy to have conversations with anybody for 15, 20 minutes as well, just to see what there may be there to help and be that resource. The one thing that I want to make clear is that I believe everybody should have an opportunity to be financially successful. And it shouldn't be because you have a certain amount of assets to manage, or it shouldn't be because you're a certain net worth. In my mind, if you're interested and willing to do the work and you want to be open to coaching and guidance, then me or my team or somebody on my team is open to helping those folks. So conversation never hurt anybody, and I'm willing to do that.
Yeah, and I really hope that our listeners take advantage of that, because just getting a 10 to 15 minute conversation can open a lot of other questions and so forth that you just might not be thinking. And if, like how Neill said, if you're willing to take that effort and put in the time and so forth, great team over there at Strategic Wealth Partners. So definitely look up Neill under the website strategicwealth.com.
Yes.
And in the meantime, if there's anything that we can keep doing for you guys, please let us know. But Neill, thanks again for being on our podcast here. And until then, have a great day.
Yeah, thank you, everybody.